Kristen Collins from the Virginia Department of Taxation. Good to see you all today. So the purpose of my presentation today is to explain at a very high level the key provisions of H.R. 1 that could impact Virginia tax returns, and also share the preliminary estimates that our team has generated on the potential impact to Virginia revenues. So as you all are aware, H.R. 1 is the large bill that passed Congress July 4th of this year. Among other things, there were a number of tax policy provisions in there, both tax extenders, so extending existing provisions and existing law that were set to sunset, and also modifying some new provisions, and also making some modifications to provisions of existing law, like some of the TCJA, Tax Cuts and Jobs Act provisions. So a few caveats before we get into the details, just because there's a lot in the bill, and I just want to clarify what I'm focused on today. Yeah, is that an understatement? So many of the provisions that have been discussed don't impact Virginia revenues. So things like changes to federal tax rates, and most changes to tax credits, that doesn't impact the Virginia return. It just impacts individuals and businesses' federal tax returns. Many of the individual provisions, particularly a lot of those that have been headlines in the news, are really below the line adjustments. So things like you've seen about tips, overtime, deduction for seniors, those are things that fall below the adjustment for income, so those don't flow through to the Virginia return. But we have done a preliminary analysis of what those things would look like if the General Assembly wanted to adopt a similar policy, and I have a slide towards the end of the presentation I'll touch on briefly, but that's not what we're talking about when we talk about tax conformity. Those aren't things that impact income that flows through to the Virginia return, and would require a separate action of the General Assembly, legislative action. And then finally, there are some provisions that have an indirect effect on revenues, regardless of whether Virginia returns. So things that you've seen about the state and local tax cap, the cap on that deduction, the SALT cap, and the federal standard deduction increase. Those are things that could impact decisions on the Virginia return. So under Virginia law, a taxpayer must itemize or claim the standard deduction on their Virginia return based on the election they make on their federal return. So when there are federal tax policy changes that drive that decision on the federal return, it will also impact their decision on the Virginia return. However, those things will flow through to Virginia regardless of whether the General Assembly conforms or not. They don't have to make a conformity decision on those things. And those things are handled through the revenue forecasting process. And then finally, those of you who probably recall a lot of the TCJA discussions back in 2018 and 2019, you might recall that a big component of the Tax Cuts and Jobs Act and the revenue impact on Virginia was individuals' decision whether to itemize or claim the standard deduction, because the TCJA had some really big changes to the standard deduction. It had a lot of limitations and reductions in the amount of itemized deductions individuals could claim. And then also Virginia's standard deduction was much lower at the time. So those things aren't really as significant in the current bill in H.R. 1. So that's really the current revenue impact that we're looking at when we talk about tax conformity in Virginia is really driven largely by a limited number of business provisions. So there are a lot of provisions that will flow through to the Virginia return, but only a few will have a significant impact on Virginia revenue. So just wanted to kind of put all that out there for a little bit of context, because there's a lot going on and it can be extremely confusing. So first, just a quick recap of where Virginia is in terms of conformity. So tax conformity, as you probably all are aware, pertains to any definitions of income at the federal level that are the starting point of the Virginia tax return. So for individuals, we're looking at what their federal AGI is. That's the starting point of the Virginia tax return, and then any Virginia modifications are made to that amount. And then for corporations, we're looking at federal taxable income. So again, looking at the federal income definitions and then going from there. And Virginia generally conforms to federal law with a few limited exceptions that the General Assembly has adopted over time. So historically, Virginia had rolling conformity up till 2003, So rolling conformity means that when Congress takes action, the state would automatically adopt those provisions. No affirmative action required of the legislative body of the state. And then if the legislative body disagreed with any items, they would have to enact legislation to specifically deconform from those items. So Virginia had that up until 2003. Then for about 20 years, we had what's called fixed state conformity, where in order for the state to conform to changes to federal law, the state has to adopt explicit legislation conforming as of a specific date. So in Virginia, historically, that's been typically December 31st of each year. So each General Assembly, the General Assembly would advance the date by a year to make sure we adopt any changes that were enacted by Congress during the prior year. And then again, if there's anything specific the General Assembly disagreed with, they would deconform from those specific provisions. And then in 2023, we adopted rolling conformity with some thresholds. So Virginia, under that law change, would automatically conform unless a particular provision had an impact of more than $15 million on the state budget, or in aggregate throughout the year, all provisions had an impact of more than $75 million. The Appropriation Act that you all passed this past session in 2025 pauses that rolling conformity for any provisions during 25 and 26. So we essentially have reverted to fixed state conformity, except there's a provision that lets any extender, so any provisions of federal law that are extended, that don't modify the definitions of income, don't have an impact on state revenues, we would automatically conform to those items without legislative action. But otherwise, you'll need to pass legislation to conform to the federal changes. You have a question? I'm sorry.
I think I might have missed something there. Yeah. I know you said we paused rolling conformity.
Yes, ma'am.
For 2025. Just repeat that part again.
Sure. So during this past session, during the 2025 session, as part of the Appropriation Act, you all made the election to pause rolling conformity, meaning that Virginia will not, for anything passed by Congress during calendar years 25 and 26, Virginia will not automatically conform, except for tax extenders that have no revenue impact. Otherwise, you'll need to adopt legislation to conform. Yep, sure. Any other questions before I move on? I know it's a lot of information. Okay. So moving on, so we kind of put things in those two buckets for purposes of this presentation. So there are extenders, which there are a limited number of those actually in HR 1 in the federal bill that are true extenders, meaning that they don't have an impact beyond just extending the sunset date or making something permanent. And then there are provisions that flow through to the Virginia return, meaning they are items that would impact those definitions of income, so AGI for individuals, federal taxable income for corporations, which are the starting point of the Virginia income tax. And for the extenders, so like I said, that's a provision that just merely extends existing law, doesn't have a revenue impact. And the reason Virginia, I believe, has adopted this policy is extenders don't have an impact on revenues. And the reason they don't have an impact on revenues is our revenue forecast generally assumes that any provision of federal or state law that has a sunset date in terms of tax policy, it assumes it will be extended because that's generally the case. And then if it's not extended, then we make adjustments to the revenue track. So the three extenders in HR 1, I'm not going to go into them in too much detail, but we can provide additional information if you're interested in these. One is a provision that allows rollovers from 529 plans to ABLE accounts without any tax adverse consequences. One is related to certain disaster-related personal casualty losses, just extends a provision of existing law. And then another is related to controlled foreign corporations, so it dictates the type of income that certain foreign corporations would report on their federal return. And again, because these are assumed in the forecast, there's no revenue impact, and Virginia automatically conforms to these three items. The bigger, more interesting piece for today's discussion really pertains to the provisions that would flow through to the Virginia return, and we kind of split these out into two slides. So this first slide here, slide 5, pertains to items that are modifying some of the larger provisions of the Tax Cuts and Jobs Act that passed in 2017. So the first one is an individual provision. It is a limit on itemized deductions that individuals can claim on their federal return. So when the Tax Cuts and Jobs Act was passed in 2017, Congress paused a limitation that they had in place that essentially required, prior to TCJA, required higher income individuals, so individuals making roughly $300,000 or more, the thresholds are indexed each year, but requiring higher income individuals to limit the amount of itemized deductions they could claim on their federal return. The TCJA suspended that. And in 2019, when Virginia enacted our legislative response to the Tax Cuts and Jobs Act, we opted to deconform from that suspension, which means we have this limitation in place for Virginia purposes still. We have since the Tax Cuts and Jobs Act was passed. What HR 1 does is it replaces that limitation with a new limitation. So the calculation's a little bit different, and then also the income amounts are a little bit higher. So it lines it up with the current top federal tax rate of 37% on the individual side, which is an income of $626,000 roughly or more. Those are the individuals that will be subject to the limitation at the federal level. And so some conversations in Virginia will probably be around, should we go ahead and adjust ours to conform to the federal? The other four provisions here are more business-related provisions. One deals with expensing, so requiring or allowing somebody, a business, to expense certain assets rather than depreciating them over a period of time. So it's really a timing issue. It gives them a greater benefit being able to claim them a little bit earlier. HR 1 increases the limits and the phase-out threshold for companies that benefit from this. So basically increases the benefit to companies. The third provision there, business interest deduction, there's been a lot of discussion and a lot of legislation in Virginia surrounding that deduction. But essentially, the Tax Cuts and Jobs Act imposed a limitation on the amount of business interest that a business can deduct each year, limiting it to essentially 30% of a set amount of income. And what HR 1 does is it adjusts what that calculation of taxable income that is subject to the limit is. So essentially, it increases the amount of the deduction for businesses that they can claim. And then the domestic research expenses, prior to the Tax Cuts and Jobs Act, companies were permitted to expense certain domestic research expenses. The Tax Cuts and Jobs Act required for certain taxable years for companies to amortize those over 5 years. So again, a timing issue. Instead of claiming the expenses up front, they had to claim them over a period of 5 years. HR 1 allows an immediate deduction, so basically reverts to the pre-Tax Cuts and Jobs Act law. This provision is also retroactive, so for smaller businesses, they can actually not just make the change going forward for tax year 25 and forward, which is what the general rule is under HR 1. They can also go back to their tax year 22, 23, and 24 returns and claim the deductions immediately, expense them immediately, get a bigger benefit. And we'll get back to that in a minute because that's a lot of what's driving some of the negative revenue impact when you look at the totals. And then finally, the opportunity zones, those were enacted as part of the Tax Cuts and Jobs Act, essentially to create incentives for investing in certain economically distressed areas, provided some preferential tax incentives for those investors, essentially deferring and excluding certain gains. And so HR 1 allows that prior program to sunset. It was set to sunset in 2026. It allows the sunset and then replaces it with a brand new program that is permanent and restructures some of the requirements there. All right, and this one I'll hit a little bit quicker. So these are some other of the key new policy items. So these are not Tax Cuts and Jobs Act provisions. These are our entirely new provisions. And you can kind of put them in two buckets. One is there is a floor for charitable contributions, both on the individual and corporate side, which did not exist before, meaning you only benefit after a certain percentage of the amount of charitable deductions you can claim if you're an itemizer for individuals and then for all corporations. The floor is 1% for corporations and 0.5% for individuals, so that has a positive revenue impact that partially offsets some of the negative impact. And then a special depreciation allowance for certain qualified property. And it's for existing manufacturing facilities and then also, improvements to existing manufacturing facilities and then also the cost of new manufacturing facilities. And this is something we call bonus depreciation, commonly referred to as bonus depreciation. Virginia has historically deconformed from these type of bonus depreciation provisions. So there's Internal Revenue Code sections 168K, L and M, I believe, are the three that we deconform from currently. This adds a new one, 168N. And Virginia's historically deconformed just because it's a large amount of money. And what that means, again, is a timing difference, right? Instead of claiming things over a very long period of time, you can claim them up front, which obviously has revenue implications for the state and then is a benefit to the taxpayers. So the key point for both this slide and the prior slide, because I know it's a lot of information, is General Assembly action is required to update our date of conformity to conform to any of these items. And then if there are specific items that you choose to deconform from, that can be part of the process as well. Just knowing that choosing to deconform from anything could require Virginia taxpayers to make modifications. Some of them could be complicated when they calculate their income for Virginia purposes.
Senator Boy Scout.
Thank you, Madam Chair. I have a question. If you could just clarify on the opportunity zones, would you be able to give us some more detail about what the restructuring actually contains?
I will probably have to get back to you on that because it's quite complicated and I don't fully have all the details with me. But at a high level, yes, there's some changes to the requirements, and essentially the companies and the taxpayers that already have benefited from this, their benefit will sunset and they would have to reapply for the new program and meet those benefits. But we can follow up with the details on that for you.
Thank you, Madam Chair. I appreciate it.
Follow up?
Okay, so slide 7 is probably the key slide that you as the Senate Finance and Appropriations Committee are focused on. This is the bottom line, revenue impact to Virginia, assuming Virginia were to conform to all of the provisions listed here. And I will say, too, these estimates are preliminary. Our team does the routine analysis, the same analysis we would do anytime Congress passes legislation. But we do make updates to our models each fall when the revenue forecast is updated, which generally isn't a significant change, but the numbers could shift slightly. So just kind of that disclaimer, if you see something, $1 million off here or there, that's what's going on there. So the bottom line is like I mentioned at the beginning, the revenue impact is driven by the business provisions, not so much the individual. As you can see, the individual impact estimated in fiscal year 26 is very small, about $1 million. In 27 and 28, it's actually a positive offsetting impact, largely driven by the charitable contributions floors that I had mentioned. On the business side, it's really driven, the majority of it's driven by two provisions. So the bonus depreciation provision that I had mentioned, so that's the fourth row up from the bottom, special depreciation allowance for qualified property. That is the provision that I mentioned Virginia has historically deconformed from in the past. So that's a decision the General Assembly will have to make, whether to conform to that or deconform. And then the domestic research deduction that I had mentioned previously, a large amount of that revenue impact is actually driven by the retroactive nature of the change. So as you can see in fiscal year 28, that's about a $79 million negative impact versus the $400 million in fiscal year 26. So about $320 million of the fiscal year 26 impact of that provision is due to the retroactive piece. So that could be a decision point to whether to conform to the provision fully, deconform, or consider the retroactive nature if we want to conform to that piece. And there's also a $37 million rough impact in fiscal year 27 from the retroactive piece. So that's that. Any questions on the numbers before I move forward? I know it's a lot, and we can.
Any questions on the numbers before she moves on?
Yeah.
Okay.
And we can provide more details to staff as needed too on what our assumptions were. Yeah. And then finally, before we, the final slide on the conformity piece is the impact to the 2026 filing season. And this is the main piece as the tax department we want to flag for you all. I'm sure a lot of you are already aware. But conformity legislation is extremely important to have a decision on as early as possible during session so that we can provide certainty to taxpayers and to electronic filing vendors as to what Virginia's policy is, so everyone can file their
That's the reason I asked
returns.
the question, because I think that means that I'm probably going to have to carry a rolling conformity bill. April will let me know what I need to do, but.
Yes, thank you. We love when you carry it for us. We appreciate it very much. Thank you. And so not making a decision, typically we aim for early February, and sometimes it's later, but not having a decision early in the process could result in administrative issues for taxpayers, including delaying tax season potentially, requiring them to make numerous complex adjustments on their returns and/or filing amended returns, which can be costly for taxpayers. So I'll pause there before I can also hit on the last slide if you want briefly, which are the
Any questions
other
before
four
she moves to the
provisions.
next slide?
Madam Chair,
Senator McDougal?
just if, I want to make sure I understand this, and we were trying to go back and forth to make sure I'm clear. The special depreciation is what most accountants refer to as bonus depreciation now, and that's on personal property or actual hard assets that you're depreciating instead of doing it over a longer period of time. You do it on a shorter, like a landscaping company, if they bought a lawnmower and a truck, they depreciate that in year one as opposed to having to do it over 5 years.
Correct.
Is that right? Okay.
Yep, absolutely.
So they would get the federal deduction, but they would pay more in state tax if we don't conform.
Correct.
Thank you.
Any other questions? Sure. Okay, so last slide, I promise. So this last slide, like I mentioned at the beginning of the presentation, there are some provisions that are not part of the conformity discussion. If you all elect to advance the date of conformity and conform to all the provisions of H.R. 1, you would not pick up these items, and that's because they are below the line on the federal return. They don't flow through to the Virginia return. However, if you wanted to consider similar policies at the state level, this is an estimate of approximately what the impact would be to Virginia. So the first one is a charitable deduction for non-itemizers, and what that means is generally only taxpayers that elect to itemize can claim a deduction for charitable contributions. This is a separate deduction for those who claim the standard deduction for any charitable contributions that they make. And Congress did something similar in 2020 and 2021. They had a $300 charitable deduction for non-itemizers. Under H.R. 1, it's a slightly larger amount. It's $1,000 or $2,000 for a married couple filing jointly that they can claim for their charitable contributions, even if they don't itemize. The second item is the no tax on car loan interest. So for certain car loan interest that has to qualify, essentially final assembly of the vehicle they purchase must be in the United States to qualify for it. Individuals can claim a deduction of up to $10,000 for the interest for that vehicle. And then there are phase outs based on income thresholds. So $100,000 for a single individual or $200,000 for a married couple filing jointly, it would start to phase out. The no tax on tips, and that was one that you all considered in some legislation last session as well as the last one overtime. But the tips deduction, and it changed several times in H.R. 1 before it was adopted by Congress, but the final iteration was a deduction of up to $25,000 for qualified tips received by an individual in certain occupations, with phase-outs of income at $150,000 for a single individual, $300,000 for a married couple filing jointly. And the IRS recently published some guidance on what industries this applies to, and it's pretty long and detailed there. And then finally, the last one is no tax on overtime, and this is a deduction for up to $12,500 or $25,000 if you're a married couple filing jointly for overtime pay given during a taxable year. So this is only for Fair Labor Standards Act pay. Highly compensated individuals are not qualified for it, and there's also a phase out for this for income over $150,000 or $300,000 for a married couple filing jointly. And the IRS very recently, like I believe within the last couple days, issued some draft forms and schedules on what these things would look like on the federal return, which helped the states confirm our understanding, which is that it was a below-the-line adjustment because there was some ambiguity earlier on in the process, and also gives tax practitioners an idea of how it would mechanically work.
Additional questions for Kristen? You've been thorough. Well, at least we ask our questions in between your presentations, so thank you for letting us do that.
Thank you all very much for your time.
Thank you. If there are no further questions, next we'll have Dale Farino, Chief Executive Officer of ADC, and he will present an update on the authority's finances.
Good morning, Madam Chair. Good morning, members of the
Good morning,
committee.
Dale.
I'm going to give you an overview of what's happening at Virginia ABC. I'm going to talk about industry trends. I'm going to talk about what we're doing to maximize our profit transfer, and I'm going to talk about how we close, where we are in. So the spirit industry trends and risks for our 26 budget. The spirit industry continues to experience unprecedented headwinds, resulting in negative year-over-year growth expectations. And that's due to several factors. You have inflation, you have discretionary spending going elsewhere, you have competing alcohol beverage products, RTDs, you have cannabis, you have the generational changes in alcohol consumption and buying habits of consumers. Mixed beverage licensees, those are the restaurateurs that are buying their spirits for the restaurants. Those traditionally represent about 18% of our revenue, and those declined by 2.5% last year, year over year, and compared to a 1.1 decline in our store retail sales. So we're seeing an effect not only in our retail stores, but obviously those consumer buying habits of our consumers, you can see through the decrease in the mixed beverage purchases. Supplier price decreases will result in reduced retail sale value to us. So we watch and collaborate with our suppliers to make sure we're just not dropping price. We want to make sure we're doing it from an innovation standpoint. And the impact on tariffs is unknown. We're kind of in a wait and see what's happening with tariffs. We work very closely with our supplier partners to make sure we're staying on top of that. Just so this committee knows that about 60% of our products that we bring into the state are imported. And out of that, as we all know, tequila comes from Mexico. That's 100% is imported. And that growth is probably one of our largest growth categories in the state, up to almost 21%. and the highest growing category year over year at 7.28. So this continuing, volatility across the alcohol industry, including spirits, beer, and wine, and all sectors of the alcohol industry, will continue to put downward pressure on our sales and our net profits going forward. So what is ABC doing to try to increase those sales opportunities? So I broke that down into two subcategories. Our relationship with our partners on the supplier side and what we're doing to modernize our stores. So we continue to have this open for business kind of mantra with our suppliers. We want them to know they can come into Virginia, they can sell their products, and that we'll give them the opportunity to do that. We do that by coming outside. We do 4 listings a year. We'll go outside that if we feel they have a product that we need to immediately get to the market. So we'll kind of go outside the norm and kind of get a speed to market for that. We're doing more in-store tastings in all of our retail stores. We're increasing shelf space, and to do that, we're having to obviously go through and delist those items that are not selling well. So we work with our supplier partners to make sure we're having the right parameters as to what we list and delist. And we continue to do regional barrel events and celebrity signing events throughout the year to help draw consumers into our stores. Then on our stores, we started with piloting a store in Carytown as a concept store where we wanted to try new things that we think we could roll out to the rest of the fleet of stores to kind of make that shopping experience better for our consumers. So we went in and we redid the layout. We redid the actual signage in the stores. We did some security upgrades to help deter theft in our stores. We expanded and created tasting areas in these stores. We've added frosted glass on the outside so people just couldn't walk in or walk by and see what was in the stores on our shelves. So we're using that store as a test bed to try new things from marketing that either our marketing team comes up with or in collaboration with our suppliers, their ideas. We'll bring into this concept store, try it, and if it is working, then we'll roll it out to the rest of our fleet of stores. And then what are we doing to maximize our profit commitments to the General Assembly? We continue to review all contract renewals and purchasing requests that are greater than $10,000. So we meet weekly and go through every expense that's over that $10,000 threshold to determine if that's something we need to do. We continue to have opportunities to reduce our operating costs without negatively impacting our store revenues. So we work with our real estate committee to achieve, favorable lease terms and identifying opportunities to improve overall profitability in our stores. We continue to evaluate opportunities for retail locations, and we do seek the legislative feedback prior to finalizing those decisions. We are currently have no new store openings planned in the foreseeable future. We to date have closed 2 stores, and we have another 11 or so that we're working through for lease to come up and terminate. So we are looking at our stores to help reduce our operating costs, which will help maximize our profits. We continue to also, when someone leaves the authority, we just don't automatically backfill that role. We actually bring the leadership team in, and we go through and analyze whether that role needs to be backfilled or not going forward. And we do that so that we kind of make sure that we're continuing to keep the business continuity going, but we also want to make sure that that role is needed within the authority. So cost structures doesn't necessarily scale when sales decline. And basically what I wanted to point out to this committee, about 11% of our budget is within departments that have no real ties to our revenue. So that's our regulatory enforcement and licensing, our legal and hearings departments, and our community health and engagement. Those departments, regardless of what's going on with retail sales, they're out full force, 24/7 doing what they need to do, and we do not cut those back when sales start to decline. Store personnel and operating expenses to support our 400 retail stores are not reduced when sales go down. We need those people in the stores to keep the stores functioning. We try to work with current lease agreements, and we lack a termination for convenience clause in our leases, which means if sales aren't going well in a store, we don't have the ability just to shut that store down.